What factors are critical to successful leverage buyouts? Although many factors contribute to the success of LBOs, studies suggest that target selection, not overpaying, and improving operating performance are among the most important. Target selection. Private equity investors often argue that their ability to find or source deals in which they have some insight not widely known in the industry provides significant value creation potential. For every 100 firms considered, the average private equity firm investigates in detail about 15, signs a purchase agreement with 8, and actually closes on 4. Attractive LBO candidates have little debt, significant tangible assets, predictable positive cash flow, and redundant assets. Competent management is always crucial to the eventual success of the LBO. Finally, firms in certain types of industries with revenue enhancement opportunities, part of larger firms, and without change in control covenants also are attractive. Firms with little debt, redundant assets, and predictable cash flow. Target firms likely to have significant borrowing capacity are those with cash in excess of working capital needs, relatively low leverage, and a strong performance track record. Firms with undervalued assets may use such assets as collateral for loans from asset-based lenders. Undervalued assets also provide significant tax shelter because they may be revalued after closing to their fair market value and depreciated over their allowable tax lives. Operating assets not germane to the target's core business can be divested to pay off of debt. Firms whose management is competent and motivated. Management of the firm to be taken private is normally given an opportunity to own a significant portion of the firm's equity. On average, 17% of the firm's equity is allocated to the CEO and employees, with the CEO receiving about 8%. Unlike acquirers of public firms, which retain the target's CEO about 31% of the time, private equity acquirers do so about 60% of the time. Public company targets have layers of management and the ability to replace the CEO without disrupting the firm's post-merger performance. Private equity firms place a higher value on retaining the CEO and are willing to pay a higher premium for the target firm if the CEO and management is willing to stay to create greater post-merger stability. Even then, turnover may be inevitable, although private equity investors rarely recruit a new management team when they acquire a firm. About half end up doing so at some point after the takeover is completed. Firms in attractive industries. Typical targets are in mature industries such as manufacturing, retailing, and textiles. Such industries usually are characterized by large tangible book values, modest growth prospects, stable cash flow, and limited research and development, new product or technology spending. Such industries are not dependent on technologies and production processes that are subject to rapid change. Firms with significant revenue enhancement opportunities. The most attractive firms are those with significant revenue growth potential and that provide substantial value-added products or services. Value added in this context refers to firms that can take products or services comparable to the competition and differentiate them by adding features and functions highly valued by their customers. This differentiation enables them to charge higher prices than their competitors. Firms that are large company operating divisions. The best candidates for management buyouts often are underperforming divisions of large companies in which the division is not considered critical to the parent firm's strategy. Frequently, such divisions have excessive overhead, often required by the parent, and expenses are allocated to the division by the parent for services, such as legal, auditing, and treasury functions that could be purchased less expensively from sources outside the parent firm. Firms without change of control covenants. Such covenants in bond indentures either limit the amount of debt a firm can add or require the company to buy back outstanding debt, often at a premium. Whenever a change of control occurs, firms with bonds lacking such covenants are twice as likely to be the target of an LBO. Not overpaying. Overpaying can result in excessive borrowing to finance the deal. Failure to meet debt service obligations often requires the LBO firm to renegotiate the terms of loan agreements. If the parties to the agreement cannot compromise, the firm may be forced to file for bankruptcy. Highly leveraged firms also are subject to aggressive tactics from major competitors, who understand that taking on large amounts of debt raises the break-even point for the firm. Competitors may gain market share by cutting product prices. The ability of the LBO firm to match such price cuts is limited because of the required interest and principal repayments. Private equity acquirers appear to be particularly astute at not overpaying. Using leverage to hype financial returns, they tend to pay lower premiums for targets that are not properly valued by investors. However, they do pay higher premiums for targets that have attractive long-term growth opportunities. Improving operating performance. Ways to improve performance include negotiating employee wage and benefit concessions in exchange for a profit sharing or stock ownership plan and outsourcing services, once provided by the parent. Other options include moving the corporate headquarters to a less expensive location, pruning unprofitable customers, and eliminating such perks as corporate aircraft. Firms with private equity investor representation on their boards are more likely to display higher announcement date returns and improved operating performance than firms without such representation. Research shows that new owners choosing to retain their investment longer, such as private equity investors, have more time to put controls and reporting monitoring systems in place, enhancing the firm's competitive performance. Other factors contributing to post-buyout returns include professional management and the private equity firm's reputation. Research also suggests that public to public IPOs, so-called reverse LBOs, show greater post-IPO performance than IPOs. Why? Investors can review the firm's historical performance when it was public and benefit from any restructuring while it was private. Thank you for your listening.